Is Nvidia stock still undervalued? In this video, I'm going to break down the bull case and bear case for Nvidia so you can make your own decision. We will look at some articles, valuations, and forecasts, and at the end, I will give you my opinion on Nvidia. But remember, this is not investment advice. Please do your own research and, in general, don't take investment advice from people on YouTube. Let's start with the bull case for Nvidia. Nvidia reported earnings a couple of weeks ago, and the company beat analysts' expectations in terms of both revenue and profit. These impressive results were driven by a massive increase in demand for their current Hopper GPUs, as well as their new Blackwell chip. Nvidia has also improved its net profit margins, as well as its free cash flow. Nvidia is at the center of attention right now because of the hype and high expectations around generative AI. It seems that everyone is embracing AI as something that is going to drive economic growth and boost corporate profits. According to a study from PwC, AI could potentially contribute $15.7 trillion to the global economy by 2030. According to research from Bank of America, there will be $900 billion in global revenue from AI hardware and services by 2026. While it all sounds really promising, Gen AI requires a lot of computing power to support learning and operating those large language models. And that's where Nvidia steps in. According to this article from CNBC, Nvidia controls between 70 and 95% of the market for AI chips used for training and deploying models like ChatGPT. In fact, many companies are even willing to wait for Nvidia GPUs rather than buying from their competitors like Intel or AMD. In March, Nvidia announced its most advanced product up to that point, Blackwell. Blackwell supports large language models with 1 trillion parameters. To put that into perspective, GPT-4 reportedly uses 8 LLMs with 220 billion parameters each. Nvidia's new platform enables the training of generative AI models up to 4 times faster and reasoning up to 30 times faster than its H100 GPU. Blackwell also has a total cost of ownership and energy consumption that's up to 25% less than the company's Hopper GPU architecture. All in all, Nvidia's stock is up 130% year to date and up over 3,000% in the last 5 years, becoming the world's third largest company with a market cap of $2.8 trillion. But Nvidia bulls believe that this is just the beginning. Some analysts go as far as saying that Nvidia's stock has 258% upside as its impenetrable moat will propel it to a $10 trillion valuation by 2030. Nvidia's CUDA software platform is another pillar of its success, serving as a key differentiator from competitors like AMD or Intel. CUDA is the backbone of Nvidia's GPU programming, as it provides a comprehensive toolkit for developers to harness the full power of Nvidia's hardware. This platform's extensive use among AI engineers ensures a loyal and expanding user base, much like Apple iOS ecosystem locked users into its devices. The platform's already widespread adoption in AI development ensures Nvidia remains the preferred choice for cutting-edge applications, further solidifying its market dominance. Finally, on Sunday, Nvidia announced its next-generation AI chip architecture, dubbed Rubin. Nvidia has also pledged to release new chip models every year, rather than once every 2 years like it used to in the past. So, in a nutshell, the bull thesis rests on a prediction that AI is going to be driving economic growth and corporate profits in the future, and Nvidia is best positioned to be the company that is going to power this new AI revolution. Now, let's cover the bear case. First, a significant portion of Nvidia's revenue is heavily reliant on a handful of large cloud providers. In the last quarter, Nvidia reported $26 billion in revenue, with 86% attributed to data center segment, and major cloud providers like AWS, Microsoft Azure, and Google Cloud contributed nearly 45% of this revenue, translating to approximately $10 billion. This heavy dependence on a few key clients can potentially pose a substantial risk, especially if these clients alter their purchasing patterns. Recent trends indicate that these cloud giants might have been front-loading their chip purchases. This surge in buying activity is driven by a rush to integrate Nvidia's latest AI chips to enhance their AI infrastructure. However, such a purchasing spree is unlikely to be sustainable in the long term. Once these initial integration phases are complete, the demand for new chips could see a significant drop. In addition, despite the heavy investment in Nvidia's chips, cloud providers have not demonstrated a corresponding substantial growth in revenue. AWS, for instance, reported $25 billion in revenue in the recent quarter, making a 17% year-over-year growth, which is only a slight improvement from previous quarters. This modest growth suggests that while cloud providers are equipping themselves with advanced AI capabilities, the monetization of these investments has yet to materialize. Should this trend persist, it could lead to a decrease in future chip orders, directly impacting Nvidia's sales. Moreover, the competitive pressures in the AI and data center markets are intensifying. AMD and Intel are rapidly developing their own AI chip technologies, and according to this article, Apple is reportedly developing its own chips to run AI software in data centers. Meta and Google announced their own in-house AI chips, directly competing with Nvidia. So as you can see, the competition is really intensifying, and as those tech giants roll out their own chips, Nvidia's revenue might take a significant hit. But the largest argument underlying the bear thesis for Nvidia is that many people believe that generative AI technology is overhyped. In fact, generative AI might have already peaked, and if we're going to see improvements in those AI models in the future, those improvements are likely going to be marginal. A new paper found that generative AI models actually perform poorly on long-tail data and require exponentially more data to achieve even linear improvements in performance. In this video by Computerfile, this paper is really well explained. So if you're interested in learning more about it, I recommend you watch that video. But in a nutshell, because of how inefficient those models are at learning and how much data it takes for them to learn, we might see a plateau in AI technology relatively soon. Another thing that I hear really no one talk about when discussing Nvidia is that when you buy Nvidia as a part of a generative AI investing thesis, you're not only betting that all the expectations behind Gen AI will materialize, you're also betting that this is going to be powered by GPUs, and you're also betting that Nvidia is going to continue dominating the space. Now, when it comes to valuation, Nvidia's metrics are notably stretched, as really high expectations are already baked into its current stock price. Despite the company's impressive technological advancements, the forward PE ratio of Nvidia's stock is higher than almost all its peers, indicating that the market may have priced in unrealistically high growth expectations, and this scenario in general is rarely sustainable, and it could lead to a significant correction if Nvidia fails to meet these high expectations. Seeking Alpha gives a valuation grade of F, but notably its trailing price to earnings growth ratio is an A, and its forward price to earnings growth ratio is a B+. Everything else, as you can see, is either a D or an F. If we look at how Nvidia's ratios compare to its historical ratios, Nvidia's PE ratio isn't that high because of strong growth in earnings. However, its price to sales and price to book ratios are really high right now, as you can see. If we look at analysts' forecasts for the next 12 months from 33 analysts from firms like Citigroup, Deutsche Bank, Redbush, and others, Nvidia stock has an average target of $1,180 with a low estimate of $460 and a high estimate of $1,400. So as you can see from this chart, even the most optimistic analysts don't give Nvidia that much potential upside, but the bearish analysts see a lot of potential downside for Nvidia. Now, I believe that Nvidia is a great company, and I think it earns a spot in everyone's portfolio. But in my opinion, the stock is too expensive right now. I also believe that Nvidia is a type of stock that can continue being really expensive for a really long time. Whether you believe the AI thesis or not, future tech will need more and more computing power, and Nvidia is well positioned to be a big player in the computing chip space for many years to come. If you're like me and you're investing for 20, 30 years into the future, Nvidia is probably going to be a stock that you wish you bought in 2024. So my approach is going to be the following. I'm simply going to buy a fixed amount of Nvidia every week. And if the price falls more than 15% below the latest all-time high, I'm going to double the amount I'm buying, thus bringing my average cost down. This approach of dollar cost averaging has worked best for me so far in a little over 5 years of investing experience. And I believe that this is the only realistic way to beat the market over the long term. Just dollar cost average into great companies and hold. I hope you found this video helpful. Leave a comment where you think Nvidia is going from here, and subscribe to the channel for more videos like this. Thanks for watching. See you in the next one.